that's loud. Okay. Well, I think we probably should wait another minute or two, only because I know that there were 35 people that were booked in today, and so there might be a few others that come in and join us as we're going along. I really appreciate any feedback that you've got as we are going through the information. Please tell me to slow down if I need to, because I know I do get a bit animated and talk very fast. So I can see you, I can see the chat. So I will be able to see anything that you put in there. And that will certainly, hopefully, keep me on track. I'm very conscious of time today because I've got lots and lots that I want to share and that I want to go through with you. So first of all, where are you coming from? Would be great. Let's see if the chat is working so that we can make sure that we can communicate with one another. If you can put in the chat where you are located at the moment, that would be great. Kim, I can see you in Melbourne. Well, not in Melbourne, on the coast. Thanks for joining us today. Who else have we got here? Sunny Melbourne, yeah. Oh, Gin. Love that. Thanks, Dirk. Oh, and it's Gary on the Gold Coast. Well, you look like Kerry, Gary. So it's good to have you all here. Rather than just hanging around and waiting for everyone, I might as well get underway. Like I said, if you put in the chat anything that isn't working or you can't see or I'm going too fast, please let me know. And I will make sure that you get as much value out of this as I can possibly give you. So where do we start? We start on going the introduction and why we're here. Well, for most of you, you know my story already. But as a brief recap, I guess, I started off in small business tax and I loved it, but the staying up to date all the time was becoming a real drag. And at that time, showing my age, I am now, there used to be faxes every day about this thick that you had to read. And that was driving me crazy. So I moved into the big business with the Motorola's of this world, and also with BHP Billiton at the time. And I managed global teams around the numbers more than anything else. I was fortunate enough with Motorola to be in China for a couple of years over there, teaching them how to lead and how to manage teams within an accounting space, and just looking at big business numbers more than anything. Very fortunate to have that ability to do that. And then I went into franchise. I went into financial planning. And then 9 years ago, bought the Horizon Group, or we renamed it the Horizon Group, that incorporated accounting and financial planning together. And what I noticed to start off with was that a lot of business owners came to us and we were always looking in the past and we couldn't do anything to help. And it was really frustrating not to be able to help in the way that I knew that we could. So over the years, we've managed to transform the base so that we now work with business owners to help them grow their business, to help them save on tax. And the reason that it's so important to save on tax is the more savings you've got and the more money you've got, the more money you've got to grow your own wealth. And so it's really a long-term strategy of how can we help you just by reducing the tax even to help you grow your wealth over time. And so that's what we or I am very privileged to be a part of now, is a practice that is working with business owners to help them get the most impact out of what they're doing, and to ensure that they're getting great advice to help them grow their wealth. Now, why is that important? It's important because, in my view, business owners wear a whole heap of different hats at any one given point in time, and it's a hard job. It's much easier to be employed than it is to be a business owner. And doing that means that you need to be rewarded for what it is that you're doing. And that's really the ethos of where we're coming from is, okay, how can we help you to make decisions to grow your wealth? And then how do you invest that wealth for the longer term to have the lifestyle and the life that you choose to have? And so really that's the premise of why we're here today and why it's so important, is because a lot of the strategies nowadays, look, when I first started and I had all those big thick faxes, we could post-date stuff like you wouldn't believe. We could go back and make changes. Nowadays you can't. A lot of the things that we previously were able to do, we can't do now. And so we really have to make a lot of decisions before the 30th of June and act on them before the 30th of June. And really what that means is, I guess I've got much bolder over the years to say, if you don't meet with your accountant between the 1st of April and the 30th of June, then you are categorically paying too much tax. And so some of the strategies that I'm going to share with you today are those strategies that we go through with clients to help them to see which ones are the best ones for them to take advantage of, to be able to achieve whatever result that they want. Now, we have to remember that when we're looking to save on tax, we're looking to bring the profit down. Now, if you are looking at considering going for finance in the next, say, 1 to 2 years, Mr. Finance won't be very happy with me. So we have Mr. Finance is wanting to see the profit up and I'm trying to pull it down. So we have to do this bit of a juggle and make sure that the strategies that you use are the most appropriate for you. So that's why now is so critical, and why end of financial year, with it just being around the corner, it's like 6 weeks away, that there's action that's required now to be able to take advantage of those strategies. So, okay, here we're trying to get to the next slide. Okay, so here's a quick agenda of what it is that we are going to be flying through at Knots. To start off with, we're going to look at some quick wins. So really, it's really 3 things today. Some quick wins, things that you can take action on before 30th of June, some longer term strategies that may or may not be applicable but are worth knowing because you never know when they are applicable. And then the third one is really what wealthy business owners, the strategies that they know that most people aren't, it's not out in mainstream and may not necessarily be something that they know. Then we're going to have a look at some mistakes and traps. I've got a special offer for today, and then I'll open it up for questions. With as many as I can, I will answer while we're on the call. So, are we ready to get started? Should I just check that everybody can hear me again? Can someone let me know that you can hear me? Just stick it in the chat. It's very quiet. I might be talking to myself the whole time. Oh, great. Thanks, Kim. Thanks, Dirk. Okay, some quick wins, some very quick wins. These are things that are actionable, very actionable by any business owner. Again, I'm always conscious of the fact that the aim of the game is to legitimately pay less tax. But you've got to take that into consideration with the cash that is required to do that. I often say, don't spend just to save on tax. But you know what? Everybody has a different objective on that and a different view on that. My job is to provide you with strategies. Your job is to choose which ones are most appropriate for you. So the first one that I'm going to start with is the instant asset write-off. Now, in the years that have gone past, we've had lots more options in this space. You know, a couple of years ago, some of my trucking clients were able to write off a $750,000 truck as a truck deduction, as a one-off deduction in that year. That was great. It was also around COVID, not so great. At the moment, the instant asset write-off is $20,000. That's what the current limit is. That's for one asset. So you can have multiple assets up to the $20,000. Can't be $20,000.01, can only be up to the $20,000. Now, why it's so critical is you can only do it up to the 30th of June. From there, it goes down to $1,000 next year. So let's say you even buy, I had a client yesterday who bought a laptop for $3,000. Great, this year we get it as a $3,000 deduction because he's had it delivered. It has to be installed ready for use, they call it. So delivered before 30 June. Now the invoice needs to be dated before the 30th of June. Doesn't mean you have to have paid for it in most cases. So that's just an extra tip there. So you get it delivered before the 30th of June, you've got the invoice, you can claim it. If he bought that same $3,000 laptop on the 1st of July, it works out that for him being in a company, he's getting a 25% deduction. After the 1st of June, it comes about 3.8% deduction. Like it's crazy the difference that it makes. So if you need a new laptop, you need a piece of equipment, you need any equipment that maybe is bigger, but we can split it up into 2 pieces to be under the 20,000, to do it before the 30th of June is highly recommended, because next year you won't get the deduction the same way that you will this year. So that's number one. Number two, pay your employees super. It's one of the very few things that you actually have to physically have paid for it. You know how before I said, oh, as long as you've got the invoice that's dated before the 30th of June for your asset, you can claim that as a deduction then. Your employees super doesn't work like that. You're going to pay it in July anyway. Just bring it back and pay it before the 30th of June, and you'll be able to get it as a tax deduction this year. Now, why that's critical is we're looking at this financial year to make sure that we can reduce your tax this financial year. Next year, we'll worry about next year because we don't know what's going to happen next year. You know, the world could blow up next year. We'll worry about that next year. This year is the critical time period for us. So by paying your super now, you get the deduction this year. If you don't pay it until the regulated time in July, you don't get it until next year's benefit. So I guess to rewind one step too, to think about it, what we're working on now, we're looking at the financial year to the end of 30th of June 2025. But that tax is not actually due and payable until the 15th of May for most people, 2026. So if you think about it, you're getting a deduction after the 30th of June. You're talking about tax that you're not due to pay until 2027. That's too far away. No one wants to think about that all the way out there. So let's just look at things here. However, if you weren't going to spend the money in, say, July, August, or September, I always recommend that, you know, if it's something that was on the radar in those months, then maybe bring it through towards the 30th of June, before the 30th of June. But if it's further out than that, you really have to consider the cash flow consequences of it. But going back to employee super, pay it before the 30th of June because you're going to pay it in July anyway. Okay, number 3 on that list there, pre-pay your expenses. Now, the typical things that I see here are rent, insurance, those things that are subscription based or membership based. Often we can get those prepaid 12 months in advance. And now, just as a bit of a teaser for later on, we are going to talk about self-managed super fund and having your commercial property in there. Now, imagine if you were the world's best tenant for yourself, you could pay 12 months of rent up front if you would like to do that. So prepaying your expenses, again, consider cash flow. Now, the opposite of that is deferring your income. So most businesses are being taxed in a way that it's not based on when you receive the cash or when you pay the cash. It's based on invoice date. So what that means is if you're going to issue an invoice, if you've got a business where you would issue invoices in June, perhaps if you didn't invoice them in June and you invoice them on the 1st of July, what that means is that that income is actually in next year. So what you've done is decrease the income this year and therefore the tax on that as well. Again, you've got to consider, well, when will the supplier actually pay those invoices? Is it going to impact my cash flow? But it is a legitimate strategy. It's about the date of the invoice, not the payment of the invoice. Now, the next one there is writing off bad debts. When we're looking at the expenses of the business, if you can't collect from somebody, if you've determined that there's somebody that isn't going to be able to pay for whatever reason, then what we can do is write off those debts as bad now, which again decreases your sales and therefore your tax. Now, let's just say some of my clients have said, well, what if they come back and pay? Am I not allowed to accept it? No, you absolutely can. If somebody's going to come back and pay, we definitely want that income, and we'll bring it in the year that you actually receive it then. So we may have written off the tax debt in this financial year, and then next year something happens and they have a windfall and they come and pay you, then we'll bring it in as income then. So definitely can write off bad debts. It's the time to look at those right now. And then the last one on this list of quick action wins is if you are in the business where you have stock, is definitely to do a year-end stock take. And not only the year-end stock take, but look at, again, what stock you've got that may be not saleable or is stuff that we would write off. And again, we're going to write it off, and that means you get the tax advantage this year. Now, just as a bit of a story of one of my clients who is in the business of stock, and they do hold a whole heap of stock, and she had gone through to work out that there was going to be a whole heap of stock that was written off. Now, unfortunately, we didn't have the conversation around you don't actually have to destroy the stock. You can keep the stock. So again, you might be able to sell it next year or the year after, rather than destroying it. So definitely don't do what she did and destroy the stock that was there and she was holding. So just as a bit of a recap, there you go. There's 6 strategies that you can action or look at right now that are easy enough to determine for yourself whether it's something that is going to be of advantage to you and your business. Okay, let's have a look at some longer term strategies now. Here's a couple of longer term strategies that we talk to clients about all the time. Anyone that's ever done tax planning with us and tax minimisation with us will definitely know that we talk about superannuation as one of the free kicks, partly because you get a tax deduction for the super, and that super is being paid to you into your super account for your retirement, so that you can use it in the future, again, for your retirement. Now, what has happened in the past is each year that there's a cap, this year there's a cap of $30,000, and that's $30,000 that has been either contributed by an employer, say you were employed by yourself, and that SGC component comes off of that cap, and then your own personal contributions, which you can claim a tax deduction for. Now, what the government worked out was that small business owners tend to look after everybody else and not necessarily look after themselves. And so now it's possible that you can have the $30,000 for this year, plus the previous 5 years, whatever you haven't used up to the cap in those years. And that can be quite significant. Now, some clients go, oh, you know, do I really want to put this money into super? Now, some of the things to really consider, and what we see quite often is, or not quite often, but we have seen, and I'll tell you a story about it in a minute, that super is protected. So as long as you are not funneling money into super when your business is not doing well, if something happens, something catastrophic happens to your business, then your superannuation is protected. So from an asset protection point of view, it is worth putting money into super. Again, it's a strategy depending on age, depending on how you feel about super. But the other big thing about super is that the tax environment means that it's only taxed at 15 cents in the dollar. So a good example is, as an individual, you're going up from 0 up to 47 cents you're paying in tax. And it doesn't take long when you're a business owner getting up to that 47 cents. So you don't want more income from, say, an investment like a rental property into your own name. Who wants to pay 47 cents in tax? Certainly hurts my heart when clients are paying 47 cents tax. So if you had a rental property in your, and again, this is a strategy for a self-managed super fund. You can't go out to an industry fund and say, hey, Mr. Industry Fund, please can you invest in the rental property down the road for me? That's something you have to do with your own self-managed super fund, and you get to choose that. If you've got a rental in your self-managed super fund, you're paying tax at 15 cents in the dollar. That's a big difference to 47 cents. And then when you retire, let's say you've still got that same rental property, that 15 cents, you go into pension phase, becomes zero tax. So there's some real advantages of getting money into super, not only for the tax deduction that you get at the time, but also because in the longer term, it's helping you to grow your wealth, and it's in a lower taxed environment than what it is in, say, your own name, or even in a company that pays tax at 25 cents in the dollar. Okay, the next one, electric motor vehicle. Now, again, this is a bit of a polarizing subject for some of our clients. You know, we've got people, and one of my tax managers, particularly Andrew, is like, you need a diesel car, you need a fuel car, because with as many kilometres as he's doing, he needs to be able to have that sort of vehicle. However, if that's not something that is really important to you, it is very worthwhile considering an electric vehicle, purchasing it in the business. So it's a little bit technical, so I am going to try and simplify this. Just bear with me for a minute. So the reason that it is so advantageous to not pay something called fringe benefits tax is we have to go back through time. So that time when I was reading those big, thick faxes, the tax office, who are very clever in that their business is collecting tax, they determined that there were business owners who were paying wages and salaries to some people, but then they were also paying school fees or mortgages or other educational expenses or stuff for the kids. And the tax office looked at this and went, hang on a minute, we only get tax from the salary and wages. We're not getting anything from all those other things that are being provided to these employees. So they implemented some legislation called fringe benefits tax. And essentially what that means is any benefit you or an associate is getting out of the business is termed to be a fringe benefit, and it's taxed. And it's taxed quite punitively. So we generally very rarely see too many fringe benefits now, except predominantly motor vehicles and car parking, unless what happens is we calculate what the actual use or the benefit that was provided to the employee, and then the employee contributes that back to the business. So let me give you an example with a motor vehicle. So you buy a petrol vehicle, you've got running costs. I'm going to keep this simple so that I can calculate the maths while I'm talking, or I have to get my calculator out. You spend, say, $20,000, or let's say $10,000 on motor vehicle expenses for the year, and 10% of that is private use, 90% is business use. Well, if that's the case, that 10%, so the $1,000, you need to reimburse that into the business, because effectively the business has paid that for you and you personally have to reimburse that into the business. Now, that's fine if you're talking those sorts of numbers. But sometimes we see contributions that need to be made back into the business of $20,000 and $30,000 because of the use of the motor vehicle, because of the price that the vehicle was purchased at, all of that sort of thing. And the more or the less business use there is, more you have to contribute personally. So if you then come to us and say, I've got a husband or wife that need a vehicle, should I put it through the business? I'm likely to say categorically no, because it's going to cost you more in cash. So it doesn't make sense. However, if you don't have to reimburse the business because there is no fringe benefits tax, then it won't matter if there's 0% business use of the vehicle. I would say, yep, definitely put it through the business and let the business pay those expenses. And that's what's happened with the electric motor vehicle. All of the expenses that are associated with the electric motor vehicle, regardless of how much time is business use and personal use, the business pays for that total expense. So it means that it's well worth considering, again, if you don't mind driving electric, that you would get the benefit of the deductions that you wouldn't have previously had. So for someone like my Miss 22, if she came to me and said, and if I was generous enough to say, I'll buy you a car, I would go, well, I'll buy her an electric car. If I'm buying it, she doesn't get the choice. I will buy an electric car and I can get the deduction for it through the business, whereas previously I wouldn't have got $1 for that deduction. So it's quite significant, and it can be quite significant to be able to purchase an electric vehicle. Now, a similar scenario is for when some of our tradies or anyone that really is in business that needs something like a ute. There's an FBT exemption, similar thing, for if there's 1 ton carrying capacity. Now, that is a little bit complex in terms of working out what the formula is, but essentially, if the ute can, if it isn't 1 ton carrying capacity, but it can be upgraded, they call it a GVM upgrade, to a 1 ton carrying capacity, it's just like the electric motor vehicle. All of a sudden, there's no fringe benefits tax. Again, a huge advantage. So I'll give you an example. A client came to me, it was about 2 weeks ago, and he wanted to buy an F-150, which is a big ute. And I said to him, "Oh, is that 1 ton carrying capacity?" And he went, "Yeah." And I went, "Oh, maybe just check, because we need it to be on the registration papers." Anyway, he went and he took my advice and checked with the dealer, and it was only 800 and something. So he came back to me and I said, "Okay, now let's get a quote on doing the upgrade." So for him to upgrade was about $5,500. Just by doing that, he spent the $5,500 to do the upgrade. Because he did that, he instantly got more of the GST back, and he was able to claim more of the car. And it worked out to be about a $10,000 saving this year. So it's already paid for the upgrade. And it'll be about $20,000 on an annual basis, just because he did the upgrade and just because he's avoided the fringe benefits tax. So again, there's things that can be utilised that maybe aren't a now strategy, but are a strategy that to think about when you're going to do those super contributions, or when you're looking at buying a motor vehicle and whether it's worth upgrading as well. There's some of the things that can be used and utilised if you do it correctly. Okay, let's go next. Okay, what we're up to is what wealthy business owners know. Now, I'm starting to coin the phrase WBO because it's so much quicker than saying wealthy business owners. So the key thing that I see here is that they seek advice first. And what I mean by that is, a lot of the time in the past, clients would think, "Oh, we would just come and see you once a year for tax advice." But just about every decision that you make in a business has some impact on the tax. And what I mean by that is, are you going to buy a piece of equipment? Well, when should you do it? When shouldn't you do it? What is things like the instant asset write-off, or should it be this side of 30th of June or that side of 30th of June? If you're buying an investment, if you're selling an investment, if you want to put money into super, if you're getting towards retirement, if you look, I do about 4 or 5 divorces a year. Divorce is a money thing and is a tax implication thing. Anything that you want to buy, anything you want to sell, or major life decisions is really how I would put it. Then it's worth asking the question, because the tax legislation is not black and white. Okay, it is very grey, or there is grey areas to it. There's no way that they can take into account every scenario and every possible option that's out there. And so it's best to always ask the advice first, because there's always quirks and things that we've seen. The fact that having so many business owners doing so many different things on an ongoing basis generally means that we hear about things that are going on in the market, whether it's to do with finance, or whether there's some legal strategies, or just general health and well-being of a business, and the compliance aspects of it. We're getting feedback all the time from business owners at the same time as making recommendations to business owners. So the business owners that are really doing well from what we see and what we deal with are the ones that are asking the questions all the time before they make the big decisions. The second thing, as you can see on the list, is structure, which is just a fancy word for how is it that you are either buying or selling things, in what name, in what entity. Again, a fancy word for, is it a company? Is it a trust? Is it you individually? Is it a self-managed super fund? Is it a partnership? Sole trader? Structure is around what is the legal framework within which we are working, to look at things like, first of all, do we have asset protection? Have we made sure that your personal assets are protected when you go and do this, this, or this? And then the second thing is, are we making sure that you can have the least amount of tax? You're paying the least amount of tax within the current structure or a new structure that we can recommend. Structure is by far the number one biggest opportunity to save in tax, that when you're structured right from the beginning, it can make a huge difference. And I can give you an example of that. We've had a business owner in this week. It's the first time that we've done tax planning with them, and it was actually wonderful to do with them. That in the last 6 months, they've had an extraordinary growth in their business, and they're partly structured right in that they have a company, so 25 cents in the dollar, that's fabulous. But the ownership of the company, the shareholders of the company, were the two owners in their own individual names. Now, what that means is, you know, as a shareholder, no different to being a shareholder of, let's say, the BHPs of this world, you own a share, and then because you own a share, you get a dividend in return for being a good shareholder when they make a profit. Your company is exactly the same. You can be paid a dividend. Now, for them, it means that as individuals, they're going to go up through the tax rates to the 47 cents in the dollar. Again, not ideal, hurts my heart. They're going to pay 47 cents. They've already got salaries and wages, which we were looking to increase, but to pay them a dividend as well, they're automatically in the 47 cent structure, 47 cent rate. Now, we don't want that. So the very first thing that we looked at was going, oh, we don't want that to be individuals. We need that to be a trust, so that they've got their own family trust each, so that we can then, we've got some flexibility about who we pay the dividends to, because they've got other family members that we can utilise from a tax perspective. So there's limitations to when you can do that. If you do that after your business is up and running and there's value and your company is worth something, then we've got a capital gains tax event when you're selling from yourself to the new trust, which means there's tax that's payable, of which we had a similar example only 2 weeks ago with someone that had already had their business going for 2.5 years and had a significant value already. So when we transferred the trust, they had to pay, when we transferred the shares, they had to pay tax because there was a transfer of the share ownership. Whereas if we'd been able to structure it correctly from the beginning, knowing what they were going to do, we would have been able to save them on that capital gain and certainly have saved them tax along the way. So for the 2 business owners that I was talking about before, that we spoke to, we were able to transfer the shareholding prior to them actually receiving those the fabulous growth that they've had over the last 6 months. And so we were able to transfer that before the business had the value, and we could see the value in the business, and has saved them a significant amount of tax if we look at it over the long term. Okay, the third one on the list is, again, something that is not right for everyone and not right for every business owner, but is one of those things that I think is important for business owners to be aware of, and is something that a lot of our wealthy business owners are doing. So self-managed super funds, for those of you that haven't or don't know what that is, it's essentially, there's two types of super funds. There's a few more, but largely it's two types. One is the industry ones, you know, the Australian supers and the GESBs and the there's lots of them, Super SA, and or you can tell I'm an Adelaide girl, can't you? And there's the self-managed super fund, where you're looking after your own super balances. Now, there's a lot of regulation around self-managed super funds and what you can and you can't invest in. And I'll talk a little bit about that later. But one of the things that you absolutely can invest in is business premises. Now, for a lot of our tradies or business owners that are working from an office or need an office, then to be able to purchase that business premises in their self-managed super fund and have their business rent it from their self-managed super fund means that they're transferring the wealth and growing their money in super. It means that their business is paying for that commercial property to be paid off over time. And not only are you looking obviously at the capital gains for that over time, hopefully, or even at a minimum, that you are your own tenant. And there is no one who is a better tenant than what you are yourself. So again, like I said, not always the best strategy for everybody. Not everybody should be necessarily looking after their own super balances because, and I say that tongue in cheek, because I have a lot of people that are, you know, would wake up every morning or not sleep through the night because they are then responsible for providing for their retirement. Those people, it's probably not the ideal situation for them. But for those people that do want to purchase business premises and rent from themselves, not individually, but through their business to their self-managed super fund, it is an excellent tax strategy to not only grow wealth within super, but also, like I said, as being your own best tenant. So it is one of those strategies that we are seeing talked about more and more and more, but is specific, like all of these strategies, it is specific to individuals and their needs. So while I'm talking about self-managed super, I just do want to touch on one thing that I get asked quite often. I see that there are three types of people, three types of business owners when it comes to superannuation. The first ones are the ones that go, I'm going to worry too much if I'm looking after my own super. Much better to leave it in an industry fund. There's nothing worse than compromising your sleep at night. All business owners need sleep. Everybody needs sleep. Don't compromise it by being worried about your super. There's the second group who want to give it a go, but aren't sure what they're investing in. And for those people that are looking to take control of their superannuation funds, but aren't really sure, they know a bit about what they want to do and what they want to invest in, but don't know, then they need a financial planner to help them plan it out. What do they need for retirement? What does that look like? And what sort of investments are good for them? And then there's the third type, who I have a few of these, that take their super and they go, great, I'm going to invest it. I know what I want to do. I know how I'm going to do it, and feel very confident in doing it themselves. There's no right or wrong answer. Everybody is different, and everybody's choice around how they want to use those super funds is different. All I can say is that it is a strategy that wealthy business owners are using and is part of the key portfolio of tools that they use when they're looking at growing their wealth, minimizing their tax, and protecting themselves. Okay, I have been talking a lot here. So before I go on to the next things, I just wanted to make sure that that you can hear me. I know I talk a lot. I'm sorry about that. And that if there are any burning questions that you would like to ask now, because I know that we've covered off on a lot, but we'll get to some more questions at the end. I've certainly left some time available for us to talk about questions at the end. If you'd like to ask anything, comment on anything, please feel free to put it in the chat, and I will be able to see it there. Thanks, Kerry. Appreciate that. Oh, it's Gary, isn't it? Business premises versus personal property. I'm assuming you're asking the question about self-managed super. So self-managed super, you can buy rental properties. So you can buy properties that are basically, okay, let me step back. Self-managed super funds and super in general is there to provide for your retirement. And what that means is you can't enjoy any benefit from those funds while they're in there. And the classic example that I often use is vintage cars. You know, I've got a number of clients that love vintage cars and have come to me and said, you know, I could buy a whole host of them in my self-managed super fund. Well, there's some limitations because you're not allowed to register them. So you're not allowed to drive them. You're not allowed to get any sort of enjoyment from them, or any sort of use from them, even to the point of, for a maintenance check each year, you have to go and get the number plate registered for the day to do it. Plus, you've got to house it somewhere else. It's got to be insured separately. So you can see that there's a whole heap of rules around what you can and can't do with balances in a self-managed super fund. But when we're talking specifically about property, commercial properties is absolutely fine, and renting from your business for your commercial property, absolutely fine. You can also finance it, you can borrow to do that. In terms of rental properties, you can definitely do, you can buy rental properties, you can Airbnb properties. There's a few things around that, in that you can't do it yourself, you can't manage it yourself without a lot of rules and regulations. But the thing you can't do is you can't rent to yourself, because ultimately you can't enjoy the benefit of that property yourself. Your business can, your company can, but you can't personally. So, and the reason that is because a company is in its own right, its own legal entity. So it's not you and you aren't it. So your company can rent from your self-managed super fund, but it can't rent to you personally, because you can't get a personal benefit from it. So I hope that answers your question there, Gary. Dirk, you were wondering about a hybrid car. No, not anymore. Unfortunately, there was. We could have hybrids and plug-ins, but they've taken that away. It was February last year that we lost that advantage. And so now it is actually only electric cars, 100% electric cars. And the quirky bit is, and something that everybody always asks is the charging station a deduction? No, it's not. Don't ask me why. It's one of those quirky things. The car is, and all the expenses, but the electric charging station that you've got at home is not. Okay, so moving on to mistakes and traps. Okay, these are some of the things that I see quite often when we're talking about getting things done for tax planning. Like I said before, in years gone by, we could backdate stuff. We could do things like, I could talk to you now and be doing your tax for last year, 30 June 2024, and I could go, oh, we'll pay you a wage, and we could backdate it. Well, unfortunately, we can't do that anymore. So things like, if we're going to pay a salary or wage, particularly if you've had a company and you've taken the money out, which everybody does, we don't want it to be called one of those ugly Div 7A loans, which means you've ripped money out of the company and now you have to pay it back. So we look at the scenario before the 30th of June and go, are we going to pay you a salary to cover the amount of money that you've taken out, or are we going to pay you a dividend? We can do that on the 30th of June. We can make a salary payment on the 30th of June, pay your wages. In fact, we had one of our clients a couple of years ago now. We paid her $180,000 on the 30th of June as her wage for the year. Now, it saved her a significant amount of tax by doing that. If we had have done it on the 1st of July, wouldn't have been possible. Because of single touch payroll, where the tax office is now interconnected with, every time you do a payroll, it gets communicated to the tax office. We can't go back afterwards and change things. The 30th of June is the 30th of June now. So it needs to be done within that time frame. The other one that is really critical is the super. So paying super, either your employees or if you're making contributions for yourself, the rule is that it needs to be received by your super fund. So a couple of years ago, a client came to me on the 28th of June and went, I know you'd said that I needed to do this and I haven't done it. Can you help me? Now, we did get onto her industry super fund and we begged, borrowed and pleaded to see if there was some way that it could be processed so that it was reflected in her super balance before the 30th of June. And they didn't commit 100% that it would be there, but they were pretty confident that it would be. And so she went, great, okay, I'll do it. She did it over the phone. Unfortunately, it wasn't reported in her member balance account before the 30th of June. So it wasn't reflected on the tax portal, and so therefore she didn't get the tax deduction for it. So we say go for the 15th of June. Do all of your super contributions on the 15th of June, and don't run the gauntlet that it won't be showing where it's meant to. It is a pretty common mistake that I see. And now we just, whenever we're talking to everyone, we just go 15th of June, 15th of June, 15th of June. Get it in there before then, and you're pretty much guaranteed there won't be a problem. Another mistake and trap that we see is thinking that your accountant has it covered automatically. I hear it all the time, and I guess I've got much bolder over the years to say to people when they come to me, if a client, let's say I meet somebody and they're talking tax, and clearly I love talking, and they say, oh, my accountant's great. My only question to them is, do you see your accountant between the 1st of April and the 30th of June each year, every year, between the 1st of April and the 30th of June? If they say no, they categorically are paying too much tax. No question asked. And largely that's because most accountants, and I don't want to generalize, but I would be saying there's maybe 10% of accountants that go through this stuff with clients, because it's something that a lot of the time business owners have had to ask for. For me, I don't like people paying more tax than they need to, but it is about, we're very committed to growing your wealth. And so that's why we're actively now making it more readily accessible, these tips and tricks. Now, it doesn't take away from the fact that meeting individually and going through your specific circumstance isn't, I can't underestimate how, or overestimate, well, I don't know. I can't tell you how important it is that it's specific to you. A lot of these strategies can be done by yourself, but there's the flow-on consequences that you're looking at as well. So I always say it is much, much smarter to talk to an accountant who is doing the tax planning and minimisation and actively engaged in it. A few years ago, I had a client come to me and said, I went to my accountant and I asked them what they could recommend. He'd seen some of my videos from a few years ago, and don't go looking for them, they're terrible. I hope they've got at least a little bit better over the years, but he had seen one of my videos, went to his accountant and said, can you help me to minimise my tax? And the accountant just went, no, I don't do that sort of thing. Let me be clear. Tax minimisation is not the same as evasion. Evasion means people go to jail. I'm not going to jail, and I'm not giving advice to somebody to go to jail. But telling someone how to take some of these strategies and utilise them to minimise your tax, in my opinion, is what accountants should be doing. We shouldn't be working for the tax office. The tax office is doing fine by themselves. Our job is to help you to use the legislation and use the knowledge that we've got to help you to pay the minimum amount of tax. Now, my Irish clients, they are the ones that say, I don't want to pay tax ever, at all, at any point. And I go, look, if that was possible, I wouldn't pay any tax. It's not possible to pay no tax, but it is possible to have things and have strategies that absolutely will help you to pay the minimum amount of tax, or at least have some strategies that you can utilize in your circumstances so that you've got some choice about what you do and what you pay. Okay, the third one there, big purchases without a plan. Whenever my clients ring and say, I'm thinking about, let me give you an example, a real life example, because I get this one at least a couple of times a week. I'm thinking about buying a rental property. What should I do? Should I buy it in my existing company, or should I have it in a trust? Should I buy it in my own name? There's lots of different possibilities of what could be a good strategy. But for me to answer that question, I've got to know a lot more. I've got to know, what is the plan? You know, what is the plan now? What is the plan long term? Is it going to be cash flow positive now, or is it going to be cash flow negative? Are you holding these properties so that you can then get the capital growth? Are you looking to hold a whole portfolio of properties? Are you looking to buy and flip? Are you looking to subdivide? How big are we talking? All of those questions, and I know that's a lot, but all of those questions are the information that I need to then go, this is the plan for you based on the plan that you've given me. Now, if that plan changes, then you probably have to come back and let me know, because we might have to do something different. And it's because we're looking at, what is the income impact, so the tax now? What is the capital gains tax now or in the future? What are the development costs? What does that look like? How long are we holding these properties for? It's a strategy session to get all of that information for us to come back and go, oh, yep, that's the answer for you. So the big mistake is to go, oh, I've done it like that before, so I need to do it like that again. It's not that simple. It's not that simple. So it's always about looking at now and in the future, and what does that whole plan look like to have the best opportunity for protecting your assets and for minimizing your tax, which is very similar to the next one, which is the wrong business structure. I can't tell you how many times I heard such and such on Instagram or Facebook. Actually, I had a great one the other day. A client sent it to me and said, "Is this true? You know, how come you haven't told me this?" Now, I'll tell you, the strategy was that if you've got a company and then you've got a holding company, that you never have to pay tax, because you can just roll those profits into the holding company and then invest them wherever you like and only pay tax at some point in the future. I can tell you that is a rubbish piece of advice. Rubbish piece of advice. And I had several clients that came to me with a similar thing. So clearly it was trending. You can't just roll profits from one company to another and not pay tax on them. It's just not possible. That's not the way the legislation works. So be careful about what you hear where, because having the right business structure and having it all operating together in a way that gives us the most flexibility if we've got losses that we want to use, or capital gains or capital losses or crypto losses, or how we're using them all within the structure that you've got to make sure that you pay the minimum amount of tax. Okay, there, not using super strategically. We talked a bit about self-managed super funds before, and about strategies around using self-managed super funds. It is something that we continually are educating on. Oh, of course you can. Yes, you can, Gary. We are super, we absolutely can use strategically. It depends, again, like all those things that I talked about before. Is it something that is good for you, isn't good for you? But quite often it's something that people haven't considered. And so generally it's something, when we do tax planning with clients, it is one of the things that we actively talk about, because we can see the advantages of it. And it's well worth thinking about. The last one there, we just touched on a little bit before, DIY on ChatGPT or friends' advice or Instagram or Facebook. I can't tell you how many questions that I field. My friend said that they can do this. I had a great one the other day. I've had 3 businesses that I know tell me that I can pay for my childcare through my business. And I went, okay, that's interesting. Maybe we'll go and do a bit more research and see, because my understanding of the legislation and how it's written means that you probably can't. But, you know, maybe something's changed. Maybe I'm wrong. Maybe these 3 business owners know something that we don't know. So we went off and did some research, only to come back and say, unless it's on business premises and unless you're offering it to all your employees and not just your children, and it's available to everyone, is something that we might be able to start to look at. She then had a conversation with those 3 business owners about how they had it structured, only to find that, yes, for them, it was something that they offered to all employees. It was in a particular area. It was documented. It ticked all the boxes, but hers wasn't going to. So, you know, some of those things are definitely worth looking at. ChatGPT and I are very tight. we work together a lot. And I can tell you, I've got some screenshots of some really horrific ChatGPT advice around tax. I have thought about sharing them, and maybe you'll see that we've just started to post some things on Instagram, and maybe I will post some of those so that you can see them. One of the classic examples was I was fiddling with ChatGPT around the super contributions, and it said to me that the cap this year was 27,500. And I went back to Mr. ChatGPT. Oh, it's a Mr. in my head, by the way. I went back to Mr. ChatGPT and said, could you just check that for me? And I got a funny response that went, oh, great, you're on the ball, you're right, we're referencing last year rather than this year. And I'm going, now, somebody who's acting on that advice, you know, doesn't know enough to be able to go, are you sure about that? And it certainly has been, it's been an eye-opener. It's been very good. And like I said, ChatGPT and I are very close, particularly with some of the marketing that we're doing now, because that's not my strong suit. But there are definitely limitations on taking advice from friends, from ChatGPT. However, the fact that you are all here, I applaud you on growing your knowledge, because it does take a lot to run a business anyway, but to then come into something like this, I always say tax is not that exciting, but to take the time to have a look at what you don't know always helps to grow your knowledge. And what that means is you ask better questions. You're asking better questions that not only benefit you, but benefit our whole community. Because if you're asking a question because you've seen something on Facebook, guaranteed somebody else is asking me the same question. And with some of the things that we're now doing on Instagram, we're going to start to talk about some of those things that we're getting on a regular basis from clients so that we can help you to navigate some of that as well. Okay, I have done a lot of talking. You are very patient people listening to me. Okay, some key takeaways. Key takeaways are, from my perspective, is that there are things that you can action now. There's things that are strategy. There's things to know and research. Wealthy business owners, the ones that I see really succeeding, are the ones that value the education that you're getting now and take action. So taking action is the key. I do see it a lot where people are getting the information and not necessarily acting on it. I strongly encourage you to ask questions and to take action. Okay, where are we up to? Oh, here's our offer. Because you've hung around for so long, up there you'll see that we are squashed for time, particularly with 30 June around the corner. And what I've looked at that we've got available 3 spots for people to book in with us to be able to do the tax planning and strategies and minimisation. There is a couple of key qualifying criteria. The bookkeeping has to be up to date to the 31st of March because we need 9 months of data to be able to estimate out to the 12 months, and we can't do it without clean data. So we need to have all the data in so that we can then look at it, extrapolate it out to the 30th of June so that we can then go, this is your best profit that we can see, and this is your worst tax position, to then give you personalised strategies to bring that down. The other thing is that you must be available in the next week, either online or in person. And the reason that that is critical is because some of these strategies, for you to implement, you need the time to implement them. And you won't have time if we can't get you in at least next week, or at least be able to start on those strategies for you. Now, for clients of ours, this is offered at $2,750. but normally for non-clients, it's 5,500. So today what I'm saying is if you aren't a client of ours currently, we will discount it to the normal client rate. Now, the reason that it is more expensive is because we've got to learn a hell of a lot about you to be able to do this. Even for our current clients, to know what they're doing, to be able to give them actionable things actually takes a lot of time and a lot of effort. And if you saw the hair on some of my accountants' heads at the moment, you would understand why they're sweating a bit. Because it takes time and effort to get to these strategies and to be able to talk through them with our business clients, and then also to be able to support you with those strategies going forward. Afterwards, there's quite often things that need to be done. Oh, thank you, Kerry. I can see those comments, and thank you, Kim. Okay, sorry, Kim, it says, missed the start of the call regarding making one-off payments, salary payment at the end. See this being recorded, will it be emailed out? Well, I'm hoping, Kim, if I've recorded it correctly and it's going to be helpful to everyone, then our intention is that we will be emailing it out so that anyone can look at it again. Okay, so questions. I'm opening it up for any questions that you have. Yes, no problem at all, Kerry. Any questions that anyone's got that they think that they might want answered here and now, please feel free. I know that quite often when somebody asks a question, it sort of gets a few people answered all at the same time. And that's specifically why I did leave some time. So if you have got anything that you think I might be able to answer for you or you would like to know, please feel free to stick it in the chat now. And I'm going to take it off share and see if I can. There we go. I think you should be able to see me now. Can someone let me know if you can see my face or if you're just looking at a black screen? Great, thank you, thank you. Thanks for that. Any questions? Any questions I can help you with? I'm happy for you to unmute if you can do that, if you want to, or put it in the chat. Entirely up to you.
Hi, Julie. Sorry, I was trying to take it off mute. Thank you for that. Just that, as I said, I missed just the start of that part of the conversation regarding someone making a one-off salary payment by the end of June. What again was that? Just the first part of it in regards to what that was?
It was a salary. It was a business owner, and what she did was she had been, like all business owners, operating in a company and taking the money out of the bank account as she was going along.
Yep.
And then we need to classify either as it's either going to be one of those horrible Div 7A loans, which we want to avoid, or we're going to give a salary, or we're going to declare it as a dividend if it's possible, because there's only two ways to get the money out of a company, either as a salary or as a dividend.
Mm-hmm.
For her, she hadn't actually taken all of that money out of the account, but because she had significant profits, we processed a wage payment on the 30th of June for the up to the 47-cent bracket, which at the time was 180,000.
Right.
So we just did the one wage on the 30th of June rather than doing it all the way through the year, because we were waiting to see what we wanted to do from a tax planning point of view.
Right. Yep. Sorry, that was a bit the start of it that yeah. Okay, cool. Thank you.
Pleasure. Yeah, I can see somebody, Kerry, you had your hand up.
Yes, thank you. I know I'm going to be seeing you and Andrew soon anyway, but just something I've been milling around in my head is I've had the opportunity to go into other countries with my offers for my training, and I'm a bit loath to do so until I've got my trademarks. So I've just had a quote to get my trade, because I've got my trademarks now for Australia. That alone was $12,000 this year. Now I've got trademarks for the States and Canada, potentially UK as well, but just per country, we're looking at about $30,000. What do you do when you know you've got some big expenses coming, but you know you're not generating that kind of income until you do the stuff that you need the trademark for?
Mm. The hard one is the chicken and an egg. I
Yeah,
haven't got the income yet, and should I
but I need
invest?
to spend the money.
Yes. Yeah. So I guess the short answer is that's a cash flow question, definitely. But it also is, how long is it going to take you to earn that income? So if you were saying to me, I've got to spend it in month 1, but I'm going to get it back in month 3 versus month 36,
Mm,
then it's a different scenario.
yeah,
Because if it's only in month 3, then I might say, well, it's worthwhile to borrow that money because you're going to get it back. Your payback period is so quick. Whereas if you're waiting for it for 3 years, I'd probably do the tooth suck and go, I would concentrate on the countries that you are already in to grow that income there, to then justify, rather than doing it, say, under
yeah.
finance.
Yeah. So if it was, because I envisage this being a 6 month to 12 month
Mhm.
regain, because the other thing that will go along with that is I'm going to be getting my courses translated into other languages. So I can go into those countries. I'm getting lots of inquiries. Which would be the most tax beneficial way of doing that? Getting a loan against the company or doing something personally and then paying yourself back?
From a tax perspective, in a company, you're going to get the deduction for the expense that's incurred. So how you fund it is a different scenario. So it's a bit like buying a car. It's no different. Okay, you can buy a car in the company, but you can finance it or you can pay for it yourself. So then the interest is deductible if you're doing it, but the purchase price is still a deduction to the business the way it is, regardless of how you fund it.
Okay. All right. I think I understand, but I'll ask you and Andrew more questions when I see you.
Fabulous.
Thank
Fabulous. I look forward to it.
you.
Okay, anyone else got any more questions? Because we are definitely running ahead of time, because I could talk with my mouth full of marbles underwater. So if there's anything specifically burning as a question, please feel free. If you would like to book in to do the offer with us, oh, I've just made you disappear. That's not helpful. Can't see you. There we go. That offer again is to meet with the team and do the tax planning. 31st of March to the 30th of June, we're estimating to work out your worst tax position, and then opportunities to reduce that tax. If you put in the chat that you qualify, it means that you're available next week and that your BAS is done to the 31st of March. And for some of you, I know that you are already booked in because you are already clients of ours, which is amazing. So if that's all we've got in terms of questions, I do thank you so much for coming today and taking the time to attend and to grow your knowledge. I hope that you have seen us on Instagram as well. We've got Under the Horizon group, we've got things coming out to business owners and growing that presence, and also under my personal profile, under the Numbers Queen, we've also got our Tilly my Tilly, my ridgeless ridgeback, who is now in our office on a Friday, coming in every Friday and sitting with clients. I had a new client come in the other day and is saying, came in and said, I was told that you have a dog in the office for me to see and I'm really disappointed. And I went, how did you even hear that? Like, she's only been coming in for like the last maybe 8 weeks. No, apparently it's become a thing. So on Instagram as well, she has got her Friday Tilly Talk. So I encourage you to go there. We are sharing tips and ideas and stories and things that we're seeing that we think will help, and also from my cone of silence, all the things that people ask us that are a little bit, you know, left of centre, or should I do this, or could I do this, and some of them are quite funny. So thank you again for your time. I really appreciate it. And I will see some of you soon. And for those that I haven't met before, thank you again for attending. Bye to everyone. Thank you.